Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're talking and getting an update from John Rubino. And you can visit John over at his Substack page where he publishes his daily thoughts on what he's looking at from the macro side, the geopolitical side, and also what he's doing in his own portfolio for subscribers. So, John, always great to get you on the show about once a month and just see what's on your radar. I think it's hard to ignore the yellow metal. Gold has rocketed up to even higher highs than last time we talked. It's currently trading on the futures market at 32.29, but just gold above $3,200, not something I was expecting to see this early in the year. But when you think about the impact that's going to have on how the world looks at gold as a safe haven, that's one element. And then we can also, as we get into the discussion, dive into what that means for gold producers and their margins. But just from a macroeconomic factor, when you see gold at these levels and a lot of the other volatility in the general equities and even the bond market and the dollar not getting a strong bid, but gold standing out as the shining safe haven, what do you think that does as far as generalist view of gold?
Hey, Shad. Well, it could be that gold is the only thing that's going up right now. I'm not looking at every single asset out there, but stocks are really choppy, and I think they're down on balance lately. And bonds are crazy. The Treasury bond market just got whacked this last week, and yet gold is just blowing through what should have been serious resistance at 3,000. Right? I mean, in like a year and a half, it went from 2,000 to 3,000. You would think that big round number would have people just selling like crazy, and 3,000 down to 2,200 is what we would see, but it hasn't happened. And I suppose we have to attribute that to central bank buying, right? Central banks are not price sensitive. They've been told by their governments that they need X amount of gold in storage for the coming currency reset. And so they're just out there steadily buying, and that's putting a kind of a floor under gold. Actually, Jim Rickards just came out and he called gold an asymmetric trade. And his take is that, if the dollar finally goes to zero, we have a currency crisis here, and the crack up boom happens, and the dollar just tanks, then gold, when measured in dollars, goes to infinity, right? So its upside is effectively unlimited, but its downside is limited. Downside risk is limited by central banks buying without being price sensitive. So that makes it a really attractive asset to own because of the asymmetry. And that the gold to infinity thing is kind of a strong statement, but I do kind of think that's the dynamic right now, is people see gold has a lot of support. And so they're willing to buy it at this crazy high price, crazy seeming high price. And that's just keeping it moving. So be it. Finally, you and I are having fun in the precious metals market.
Yeah, it is fun. And even the people that were buying gold at Costco at 2000 don't seem so crazy now because people were giving them such a hard time when that started becoming a new trend to be able to go into a wholesale food store and also pick up an ounce of gold or a bar of gold. Now that's looking like a pretty smart decision after gold's tacked on over $1,000. But when you think about the universe that we swim in, John, with these gold equities, think about what the producers are making now as far as their margins. I mean, the average cost, I think, is around 1,500, maybe 1,600. That gives you like a $1,600, $1,700 margin. Even the highest cost producers, it's still going to give you such a big spread. We've never seen margins like this in the gold sector ever, not this big on nominal terms. I don't even think even on percentage terms. So with such a huge portion of revenues and free cash flows coming in, would you have expected to see a little bit bigger run in the gold stocks than we've seen?
Oh my God. Yeah. I would expect to see 10 baggers everywhere you look in the precious metals market right now. But there's a reason that it was a slow process. And that's because the cost of mining went up really dramatically for a few years there. And that almost completely offset the increase in the price of gold. So yeah, you're selling your gold for a lot more money if you're a miner, but you're also paying your workers more, and the big machines cost more to operate and everything. And so your margins didn't widen out the way I think a lot of people, including me, thought they would. But now gold has gone up far enough that margins are starting to widen out. At the same time, costs aren't rising as dramatically as they were because oil is down. Oil was 80 some dollars a barrel 2 years ago, or even really just a year ago. And now it's 60 some dollars a barrel. So that limits the cost increase that's attributable to mining and allows those profit margins to start widening out. So I think fourth quarter numbers were by and large pretty good for precious metals miners, especially gold miners. And first quarter numbers ought to be even better because the average gold price in Q1, it's already locked in, we're past Q1 now, is higher than the fourth quarter average gold price. So that means they made more revenue from the gold that they sold. And if they controlled their costs, we're going to see some really nice earnings reports coming very soon. In the next few weeks, we're going to see, we'll enter earnings season. So we'll see a lot of these numbers come out. And I think a lot of them are going to be really good. And, before we went live, we were talking about the royalty companies. Jeez. A lot of these guys now have gross margins. That is the money that they make over and above what they had to pay to get ounces of gold. They're making like $2,500 an ounce. And that is a massive profit margin, which is going to translate into massive cash flow for a lot of the royalty companies. So, we should probably expect an M&A boom in the royalty space here pretty soon, because somebody like Franco-Nevada, let's say, can buy a smaller royalty company that's trading at half the multiple of net asset value that Franco-Nevada is. So they buy this little company, and then the assets are instantly revalued to Franco-Nevada's multiple of NAV. And so it's a good deal for everybody. And there's no reason for that not to happen now because margins are just so wide in gold. So it took a long time for people to get excited in this market. But I think $3,000 gold is high enough to be a catalyst for some more animal spirits in precious metals mining. Unless gold tanks, unless 3,000 does turn out to be resistance and it goes back down to 2,200 or whatever, which is a total possibility. But if it doesn't happen, then I think every earnings report with all that free cash flow in it and everything is just going to get people more and more excited. And we'll see a lot of positive action in this space.
Well, it's interesting, John, because I thought that gold would maybe approach 3,000 like it approached 1,000 and 2,000, which was with hesitancy, and it had a really hard time getting through $1,000 the first few attempts. Same thing with 2,000, had multiple attempts. 3,000 had blasted right through it up to 3,100, then 3,200. Now we're north of 3,200, and it didn't have that same retreat that we normally saw. So I would say that 3,000 did not act as resistance this time, like the other two round psychological numbers did. And if we just stay anywhere in this ballpark, I mean, I hope people listening let that sink in what John just talked about. Think about royalty companies making $2,000 to $2,500 margins. Those are insanely high margins. There should be some M&A to scoop those up. But I wonder, why is there not more M&A from producers using their higher multiple to pick up development projects and even bolt-on production? We're seeing a little bit of it, and we've seen some good M&A deals over the last year or two. But why is this not an M&A fiesta right now, John?
Well, Chad, there is an answer for that. And that is that in the last cycle, in 2008, 2009, and 2011, gold went up and the miners got overexcited. They did some very big deals that turned out to be way overpriced. And they remember those times. That wasn't that long ago for these guys. And they remember how it felt in the subsequent down cycle to be sitting on all these assets that you could have bought for half price if you just waited for 3 or 4 years. So they're being conservative. They're not just stepping out and making, one gigantic acquisition after another, but, let a few more nice earning seasons come and go and some big acquisitions take place. And, you'll see that kind of action start again, because if you're running a big miner, and somebody that you consider a peer goes out and makes an acquisition that makes them 50% bigger than you, and they're on the cover of magazines and everybody's talking about them and everything like they're brilliant, you're going to have to do the same thing, right? You're going to have to do something that's that big or bigger so that you can keep up with the Joneses in your industry. And that happens every cycle. But this cycle is coming off a bust that was so traumatic that it's taking a little while longer to get everybody excited. But if stable $3,000 an ounce gold doesn't do it, I don't know what will, because like you said, margins are going to be immense. Cash flow is going to be really big for a lot of these miners. Agnico Eagle's next earnings report is just going to be wild because they're well run. They control their costs even in tough markets. And now their margins are just going to blow out. So I think that translates into more action and more excitement in the precious metal space. And so we'll just have to see. But I think the rest of this year, assuming gold doesn't get smacked back down, if we assume gold holds its current price, then the mining space ought to be a lot more fun in the second half of 2025 than it has been for any time in the last 5 or 6 years.
Well, I sure hope that it is, John, because I don't want to throw a wet blanket on the excitement here. But when I look at something like GDX, it is at a level where last week it finally closed at a level a little bit above where it did in 2020. So in 2020, if people remember, after the pandemic lockdowns and everything, there was a huge market rally in almost all sectors, gold stocks not excluded, but gold stocks really outperformed a lot of the general markets and really blasted higher in a meaningful way. And you saw things like GDX get up to a new peak, not the same peak it got in that 2011 cycle, but still a really good peak. But we're not seeing the same kind of thing when we look at the gold stocks today. Even though the margins are fatter than they've ever been, even though the revenues are growing, people said that the generalists would get excited at $2,100 gold, maybe $2,200 gold. We're at $3,200 gold, and it still doesn't seem like there's that much excitement. It just now eclipsed the peak from 2020 last week. GDXJ hasn't done it yet. GDXJ is still trading at a lower level than after the pandemic crash when gold got up to 2089. That's where it peaked out. And the margins were maybe $800. Now we're talking about margins that are $1,600 or royalty companies with over 2,000, and GDXJ, which is mostly mid-cap producers. It's mostly the mid-tier gold producers, is not even above that same level. It would have to triple. GDXJ would have to triple to get to where it was in 2011. Is there still room for more generalists to come in? Because it still doesn't seem like the excitement's really there, all things considered.
Oh, yeah. Well, look what happened in the previous decade. Gold went down irregularly for like 8 straight years. So any generalist investor who was paying attention to gold had long since, by the end of that process, stopped paying attention. So they didn't even know what the price of gold was for the last 3 or 4 years. And then, gold started to go up and it bounced off 2000 for a while and finally pierced 2000. And like you said, that should have been a wake-up call to generalist money paying attention to momentum. But the miners didn't go up along with gold because their margins didn't widen. Their costs went up along with the gold price. And so they didn't report really impressive numbers commensurate with, the price of gold or anything. So there was nothing there for generalist money to pay attention to, especially in a market where NVIDIA was going up by thousands of percent and Bitcoin. What did Bitcoin top out at? 105,000 or something like that. And then along came AI stocks and then the other AI stocks. And then along came what is it? The other big computer story.
Quantum stocks.
Quantum stocks, yeah. And so if you're a generalist investor and you're paying attention to momentum and stuff like that, there were these epic once in a lifetime stories going on until just lately. I mean, literally, and until a few months ago. So there was no reason to pay attention to something as boring as gold mining stocks. So now the gold mining stocks are going up, but you've got this whole generation of generalist investors who learned that was a boring industry, where there was nothing there of interest. So you need some really big numbers to get people's attention, to show up on their screens. And so, for instance, gold just has, on a lot of charts now, outperformed the S&P 500s in this century so far. So there's one thing that might get generalist investors excited, but that's just about gold. And then the miners, who have put up totally mediocre numbers basically forever, have just started putting up pretty good year-over-year comparisons. And that takes a while. One good year-over-year comparison is irrelevant to somebody who's a momentum investor. You need a trend. So we need more good quarterly earnings reports to start sucking people in. And, maybe it's just two. Maybe it's just the fourth quarter and the first quarter that starts the ball rolling. We don't know. And maybe we need a few earnings reports and then some big splashy acquisitions. But those are all things that $3,000 gold make possible. So we should expect them to happen. And then, generalist investors, they don't have emotional attachments or opinions or anything about gold. If it's moving, they like it. And so once it starts moving in a way that's just undeniable. Gold goes up and it takes the miners with it, and all of a sudden it's a very hot sector. Then generalist money will just pour in because they don't care that they didn't used to like gold. If it's moving now, they like gold. That's just how that part of the market works, and that's an immense part of the market. It's so much bigger than precious metals in terms of investable capital. So you could see easily gold or precious metals in general go from less than 1% of the average portfolio to 2% of the average portfolio, which is, to you and me, that's nothing, right? That's not even a rounding error. But that alone would be enough to keep gold elevated and send the miners way up from here. So I think that's all completely possible. But still, we're also looking at a recession and an equities bear market. And those things are real wild cards. They could derail a precious metals bull market temporarily. So with me saying, oh, yeah, the bull market is going to start for real in precious metals and mining and stuff like that, that means if we don't get a massive equities bear market and a really deep recession. So if the world is kind of like it is today and gold is above 3,000, then that lights a fire under the mining stocks. But we don't want to just go out and mortgage the house to buy GDXJ or anything, because you still got the macroeconomic stuff out there that you have to pay attention to. And to me, it's pretty ominous. But it's also got the Federal Reserve sitting out there just waiting to cut interest rates down to zero, because they really don't like the effects of 3, 4, and 5% interest rates. And so, in other words, there's a lot of cross currents still, even with a really good precious metals market right now. You still got a macro situation and a geopolitical situation and central bank behavior to deal with. And so you do not want to bet the farm on precious metal stocks. But at the same time, this is a good time to be looking for really high quality names across the spectrum. In other words, the big, really high quality major miners, and then the snow lines out there, the explorers who have basically outlined a really good property. So they've got reserves that they're turning into a resource. And they're on the radar screens of the big miners who are going to buy them out at some point at some nice premium and stuff like that. So, you want to be buying these guys across the boards, acquirers and acquirees, because the best of them will probably do really well in the year ahead. Don't just buy anything with gold and silver in the name, but buy some of the guys who have established themselves, who wherever they are, they're first or second in class. And, I think that's a really good bet at this point.
Well, John, just to that point, we've talked a lot about the producers so far, but when you get into the world of the juniors, so some of these companies that have development stage where they've done all their economic studies and they're trying to get the capital together to build a mine, or maybe they're pretty close to that phase. Then there's the advanced explorers that maybe have a resource out like Snowline Gold, where they've find some ounces in the ground, but they haven't really done the economics yet. But you can tell there's proof in the pudding. There's something there. In their case, 7 million ounces of gold. But then there's also the earlier stage explorers, which are the more speculative side of the sector, and that's really the wild west of treasure hunting and putting holes in the ground to try to find gold or silver or copper, etc. Now, usually when we see these big moves in the market where gold gets a bid, and sometimes if silver gets a bid, copper gets a bid, people flood into producers first, and then they eventually work their way down the food chain. This time's been a little weird in that, to your point, the high quality has continued to get rewarded. You look at gold producers like Dundee Precious Metals, Lundin Gold, Alamos Gold, as you mentioned earlier, Agnico Eagle, the best in class. They've continued to rocket higher, but a lot of the other producers, and then when you get in the juniors, most of the juniors haven't even got off the mat yet in historical terms. So do you think we'll see that cascading down into the gold sector, even if the U.S. equities are struggling, because they're the first quarter of this year, and even recently, we've seen the gold equities diverging from other equities. Is it possible that the gold strength is so strong that it keeps the gold equities from maybe correcting as hard as U.S. equities, and that gets more people saying, hey, look at the sector that's breaking away from the pack? Could that be something that plays out, even if we do see further corrections in U.S. equities?
Oh, yeah. Yeah. It's possible that central bank buying elevates gold so it doesn't go down in an equities bear market. And because of that, the precious metal miners are the only companies generating positive year over year comparisons. That will show up on momentum investor screens. And the miners will outperform big time in that kind of a situation. And that'll filter all the way down. I mean, already some of the little guys are really moving. Snowline is up 400 or 500% now, and Goliath Resources and Hanan Metals and Sitka. These are all triple digit percentage increase stocks in the last year. So, it's starting to happen with the perceived really high quality smaller companies. And now that needs to spread a little bit, and there needs to be some acquisitions at really nice premiums. And then all of a sudden you've got a hot sector. And then the generalist money starts coming in and buying the names. In other words, something has silver in its name and they start buying it. And, that will come. That's part of the cycle. So it's a good thing to own the really high quality explorers along with the junior producers and the big guys. Just go for quality right now because there is a lot of quality out there. And it's much easier to sleep at night when you've got something that even if its price is fluctuating, that the company is doing great. The drill results are coming in, or the margins are getting wider, or whatever metric you want to use for a company of the size. As long as you're in something like that, you can put up with the squiggles that are inevitable. There will be ups and downs in this market. Bull markets don't go in a straight line, and you've got this big equities bear market staring you in the face out there. But as long as you're in really high quality, then a correction is just a chance to buy a little more or something like that. As Warren Buffett says, if something you buy that you like and you understand goes down by 50%, then it's on sale because you want more of it anyhow, and they're giving it to you for half off. So you want stocks like that, things that you understand well enough to be able to judge, and that you judge to be excellent quality, and that even if they go down a little bit, that's sucks for your net worth, but it's a good thing because you want to build that position and they're letting you do it more cheaply. So that's psychologically, I think, the only way to be in precious metals, because if you're in low quality mining stocks, your life is a nightmare because bad news is coming out all the time and you're in danger of losing 100% of your positions. So avoid that. Go for quality.
Yeah, especially when quality goes on sale, like you mentioned. If you know a company is quality and you know that all the fundamental drivers are there and then it gets cheaper, you can feel a little more confident buying that dip, knowing that there's still good alpha in the work the company is doing. Let's also talk silver, though, and the silver stocks, John, because when you look at a historic gold to silver ratio, anything over 80 is considered high. We're up closer to 100 right now. You don't see that often, but there is a difference. As everybody knows, silver is an industrial metal and maybe more industrial now than even precious, probably 60-40. So that is playing into the macro concerns about a contraction or recession in silver's weakness. But then silver is also still a precious metal. It does usually get pulled along by its big brother gold. So how are you looking at silver and the silver stocks here? Are they a buy or are they an avoid?
Well, I think the silver story is great. The fact that it's an industrial metal is an issue from a cyclical standpoint, but the silver market is in deficit right now. The silver mines of the world aren't producing enough to satisfy the demands of industrial users, and that means we're using up the above ground silver stocks that are out there. So we're heading for kind of a crunch with silver, and that's mostly due to industrial demand. And then in precious metals bear markets, what always seems to happen is that gold goes up first, and then gold starts to look extremely expensive. When you look at how much a Krugerrand, which is just a small gold coin, costs compared to a tabletop full of silver coins, people just shift and start buying silver. And then that lights a fire under silver for the last couple of years of the bull market, and silver outperforms gold. Historically, when the gold to silver ratio gets above 90, and definitely when it hits 100, that has in the past been a screaming buy signal for silver, because it means silver is so cheap relative to gold that people are going to start buying it on that basis. They want protection against a currency crisis. Gold is crazy expensive, and silver is less so. So it triggers that kind of a dynamic. And then silver, which is a tiny market with very little liquidity and very thin trading, just takes off. So we're creating the conditions for that with the gold silver ratio at 100. So I would say silver is a better buy than gold right now, despite gold being the asymmetric trade with central bank buying and everything. I think silver will probably do better than gold over the next 3 to 5 years. And I think the silver mining stocks, well, there are barely any silver mining stocks. So if you can say we're one of only 5 primary silver producers or something like that, and silver itself is going way up, then you've got a great story to tell that is easy to understand for generalist money. And I think that'll generate some really good action in the silver miners. So yeah, I like silver, and I own most of the stocks that are in the silver mining space, and I'm looking at adding some more.
Yeah, you and me both, John. I think I got 19 silver stocks right now. So I'm hoping that from your lips to God's ears that the silver price does start moving more and that we see that momentum. But historically, as you say, there's the catch-up trade in silver after gold's made its move, that silver and then the silver equities then follow through. One other area that we thought it'd be fun to get into, just really briefly and from a high level, is with all the volatility we're seeing in the macro, with all the volatility we're seeing really in all equities, and gold and silver stocks are still equities, you also use options, put and call options, as a way to smooth out the volatility. Maybe just share one more idea with folks about how you use that to lessen the uncertainty in these kind of wild whipsaw markets.
Well, I tend to own long dated put options when it feels like the stock market is topping, like now. So I have NASDAQ and S&P 500 puts that go out for a couple of years, which is basically a bet that the stock market is going to go down. And that protects you to an extent against having a lot of your other stocks drop. But lately, in the last 2 weeks, the best thing to do, probably the single best thing to do, would have been volatility spreads. That's where you buy a put option, which is a bet the stock market is going to go down, and a call option, which is a bet that the stock market is going to go up on the same index. Let's say the NASDAQ. And if the stock market goes way down, then your bet on a dropping market goes up more than you lose on the opposite option, and vice versa. So in markets that are crashing and then spiking, volatility spreads are just great instruments for taking advantage of the volatility. Basically, you're betting that the market is going to be more volatile than people expect it to be. And that's not a bad bet in this world, because so many things could go wrong and so many things could go right for the world right now. And any of those things could send stocks, crashing or soaring, and they're all completely unpredictable on a day-to-day basis. A lot of what happened in the last couple of weeks was due to Trump changing his mind, going back and forth about tariffs and stuff like that. And how do you predict that? You can't. But you can kind of look around the world and say, all right, this is an especially hard to predict, potentially volatile world, and then put something like a volatility spread on. And then you don't care. You don't care whether the market is crashing or whether it's spiking. You're making money as long as it's doing one of those two things. So it kind of absolves you of having to predict ups and downs. As long as there are ups and downs, you make money. So that's something I'm kind of looking at. I mean, I wish I'd done it 2 weeks ago, although the long dated put options that I had did really well in the down part of the volatility lately. But just betting on volatility might be your best bet now.
Do you ever use them on gold producers back and forth or royalty companies?
No, but you totally could. You could buy Newmont puts and calls, right? Or GDX has really liquid options. So you could do that too. Yeah. And then you're betting on the mining sector to have massive volatility, which, in a volatile world is a pretty good bet. So you just have to watch out that other people aren't doing the same thing. And then the premiums you have to pay on those options have blown out to crazy levels where it's really hard to make money. What you want ideally is for a really placid period in which to set up your volatility spread, and then a crazy volatile period after that. But, that's a hard prediction. We will see. But yeah, you could totally do a volatility spread with mining equities, and they would probably work out for you in a time like this.
Well, just some different ideas for people to think about, different tools in the arsenal that you can use to play both sides of the market, but also smooth out some of the volatility. I don't know that we're ever going back to placid times, at least in this administration and with the way the global trade is set up right now. So it's definitely something to consider. But great thoughts today, John, on the macro side of things, what's happening with gold, what's happening with the gold equities, what's happening inside of those with the majors versus the mid tiers versus the juniors. Lots of things for investors to chew on, and I do hope that we see more action in the silver price and the silver equities, as you outlined, as a catch-up trade, catching up to the moves gold has made. But John always is putting out interesting information on his Substack page. So for those of you listening in, if you want to get more thoughts from John, definitely click on the link down in the show notes. It takes you right over where you can do a free service and just get some of the general macro commentary. But if you want to find out what he's doing in his own portfolio, I recommend subscribing to the full service. John, always great having you on the KE Report. And as always, looking forward to our next conversation.
Thanks, Shad. Talk to you soon.